Right, a very good evening, afternoon for everyone joining in. And we move on to module number 3 on financial accounting. We dive into the details for the financial statement preparation bit, right? Uh, okay, so we were touching base on let me rearrange my screens. We were touching base with some of the basics and the fundamentals as it applies to financial statements. And we dive into the detail today. Yeah, it's going on here. Right. In our last session, we identified in relation to why financial statements, who is using financial statements, what is the purpose of financial statements, what are the broader financial statements that we are going to be dealing with, what each of those financial statements again specifically are telling us, the performance, position, prospects, etc. We also touch base on the importance of the guiding principles, kind of, right? Principles and standards, and we saw how all of them are coming together. We dive into some of the details today, right? Because don't forget, the accounting space is quite vast. If you take standards, for example, between IFRS and US GAAP, it could be very, very significant, right? So let's see. We talk about the income statement and revenue recognition. So if you remember our income statement, we saw revenue, direct costs, gross profit, indirect costs or overheads. We saw operating profits. We saw taxation. We saw finance costs. We saw taxation, and then we saw net profits. Now, each of these have principles in terms of how the calculation, recognition, etc., actually work. Right? We dive into some of the detail today. An accounting principle outlines specific conditions under which revenue is recognized. Right? In theory, there is a wide range of potential points at which revenue can be recognized. Right? So, at which point do we recognize revenue is the question that we are asking. Right? And what are the basis for recognizing these values? And IFRS, for example, number one, you can see the three main criteria on the side across over here: performance, collectability, and measurability. So these are the very questions that you will be asking in the event you're talking about revenue recognition. Number one, in terms of performance, risks, rewards of ownership have been transferred from the seller to the buyer. So I'm selling a good or service to you, and now the entire risk and rewards lie with you, the buyer. If at this point of time, hypothetically, let's say there is damage to the goods, for example, is that my problem or is that your problem? It's going to be your problem. So you can see the risk and rewards have transferred to the buyer. I can recognize it as revenue. Similarly, collectability. Sorry, point number two. The seller loses controls over goods and sold, essentially as a result of the risks and rewards being transferred to the buyer. Now, the seller does not have control over it. In this instance, yes, you can tick the box. You can recognize the revenue. Collectability. Now, yes, I may have sold you the goods, but I could have sold you the goods on credit. The collection of payment from the goods or services is reasonably assured as well. See, if we think a little unscrupulously, where we might think, hey, I'm going to sell all my goods on credit, and then I'm going to immediately recognize everything as revenue, and I'm going to recognize everything as revenue. Thank you very much. Not going to work. Hold on one second. You may have sold on credit. You may be allowed to even recognize until we get the cash and the receivables. But collectability also has to be, look at these words, guys, these are very important, reasonably assured. If you look at the nitty-gritties, or if you dive into certain details when it comes to accounting standards, if you are looking at a hardcore accounting element, these points are very important. Reasonably assured. Look for these information in your questions as well. Risk and rewards have transferred. Risk, rewards of ownership have been transferred. Collectability or collection is reasonably assured. And point number 3, measurability. Of course, I have sold. Collectability is also, I know I can get whatever, but is there a value to it? Right? Which is the next point. The amount of the revenue can be, once again, notice, reasonably measured, and costs of the revenues can also be reasonably measured. This is the criteria that we will be looking at in terms of revenue recognition. If we can tick these boxes, guys, the risks and rewards of ownership have transferred, which means my performance criteria as the seller has been delivered. Collectability is reasonably assured, which means that box also can be ticked. And measurability is also reasonably assured. Now I can go ahead and recognize revenue. These are the key points that we need to bear in mind. Then we look at US GAAP, right? We saw the two different IFRSs and US GAAP that can come into the picture. US GAAP is a little different. They say, see, end of the day, guys, revenue recognition, there may be they may say that US GAAP and IFRSs are at loggerheads, right? Which is not the case, right? But inevitably there are certain tensions. But there's a lot of effort that is going into convergence between the standards. Because when standards do not match, when principles do not match, the issue of comparability comes into the picture, which reduces the quality of the overall information that we can deal with, right? So inevitably, when you look at revenue recognition criteria, broad spectrum, they will be talking about similar elements, but there will be, by definition, differences, like you're about to see. You saw performance measurement and collectability and IFRS. US GAAP tells us that you have to identify the customer contract. A specific contract should be identified. I am selling to you, I have made the offer and you have accepted. Identify the obligations in the contract. I am going to give you a good of this amount of weight in this color, in this model, or a vehicle of this model, in this make of this year. Determine the transaction price. What is the value of the respective product? Allocate the transaction price according to the performance obligation in the contract. Are there any specific details in the contract relating to the performance obligation? Recognize the revenue when the performance obligations are met. You might notice now with with US GAAP, for example, the contract, the performance obligation, the transaction price, and performance obligations being met would mean revenue recognition, right? So there has to be a contract, there has to be the contract which delineates the performance obligations, and when the performance obligations have been met, revenue recognition can take place, right? Two different but similar. You can, if you look at the basis, I personally like, and just a personal preference, like IFRS, right? Risk and rewards have transferred to the buyer. And now, if my collectability is certain and I can measure the value, I would like to recognize my revenue. If you do look at the underlying condition of US GAAP as well, guys. You would notice contract is there, performance obligation has been defined, price is measurable, and soon as the performance obligation has been met, you can recognize the revenue values. Right. These are the nitty-gritties as it will apply to revenue recognition on the income statement. We looked at both IFRS and US GAAP, which brings us to expense recognition. Right. And one of the bedrock, the fundamental of expense recognition, which we've been talking about in our previous session as well, is what? Whatever the expenses related to generating this revenue, what are the expenses related to generating this revenue? And we have just now completed the revenue recognition, right? Based on whatever those criteria we recognize our revenue, whatever the costs which are necessary to generate that revenue must be recognized. Matching. We are matching the revenue with the cost. US GAAP states that businesses must recognize revenue on their income statement in the period in which they are realized and earned. Don't forget, going back to our previous discussion in the last session, it is on the basis of what? Accruals, guys, right? And if you, once again, just to remind you on accruals, as it applies to expenses, how does it work? Incurred, but may not have been paid. Incurred, but may not have been paid. But it is relevant to the current financial period, right? So for example, let's say one of the expenses was administrative expense, right? This administrative expense is incurred. I need to pay it in this year, but I have got, let's say, a credit period, or I have used a credit card to make the respective expense. And as a result, the actual payment is only going to happen in the following financial period. Right? But this expense, which I am incurring, is related to the current financial period. Therefore, the recognition is going to happen in this respective counting period. Right? Very crucial. Businesses must be reasonably certain that they'll receive revenues upon completing an activity. Right? This is that collectability criteria coming in again. And together with the revenue recognition presents a transparent and accurate financial picture. This is the beauty of the matching principle, guys. Right? Because let's think about it. Let's go a bit wider here. So I generated revenues in year one to the value of $1 million. Right? The expenses required to generate this revenue, direct cost, indirect cost, or whatever it might be, let's say was $600 million. Sorry, $600,000. But I may actually be paying these on the second week of January because I have credit terms, because I use a credit card or whatever it might be, right? So the actual cash outflow is technically happening in the second period, the actual cash out. But see, this expense is related to this revenue in this year one accounting period, right? Without which we are at a disadvantage. Now, if I'm going to recognize revenue here and cash over here and expenses over there, how am I going to identify in this current financial year what was my performance, right? It would be an extremely difficult task. But as a result of these accruals and matching concept coming into the picture, I will recognize my revenues depending on the respective criteria. I'll recognize expenses on the matching principle, and I will recognize them on the basis of accruals because they apply to the current financial period. Now, all of these income and expenses, right? Not necessarily on the basis of cash, but all of this is relevant to the current accounting period. And now when I have my gross profits, when I have my operating profits, when I have my net profits, they make a lot more sense, right? What are the methods of how these outflows can therefore be recognized, for instance? Immediate recognition. Immediately, you will see your income statement, recognizing it as an expense. You can have systematic and rational allocation. Where do you see systematic and rational allocation? Is any thoughts? Oh, this is the easy one, right? You have, for example, salaries. You paid $150,000 salaries, you immediately recognize it in the um, income statement. Where will you see this systematic and rational allocation potential? A very obvious one, something which is a popular, obvious one. Any thoughts, guys? Depreciation. We'll talk about these later on as well, early days. Right? What happens with depreciation? We might spend, for example, $100,000 to buy a particular fixed asset. The fixed asset has a useful economic life of 4 years, right? So what makes sense that I allocate this entire $100,000 into year one? No. What makes sense is since I will be using this $100,000 over a 4-year period, what makes sense is I allocate $25,000 across the next 4 years. Systematic, rational allocation of cost. You see this as well. And then you have cause and effect. Expenses related to generating revenue, like the matching principle, for example, being recognized. There might be discontinued operations. There might be one-off expenses coming in. These will purely be contextual, and they will be driven by cause and effect. Right. All of these can form part of the expense recognition criteria. Let's look at an example of the income statement then, shall we? This is a bit of, I think, if I'm not mistaken, this is, I picked this from Apple. You can see the conventional income statement structure. You have the revenues over here, revenue and other revenue in this context. Then you have over here the direct costs, the direct costs, which essentially leads me to my gross profit. See, remember, if you remember our discussion in the last session, we were saying when we come to gross profit, we are identifying the impact to profitability. Sorry, those arrows should go one below. The impact to profitability from direct costs. We are seeing the impact of the cost of sales to revenue on my profitability. Right? And then comes the overheads or indirect costs. Why? Overheads, indirect costs, etc. Why are these? Is there a rationale for why these are separately classified kind of guys? Any thoughts? Why cost of sales and then you have the overhead separate? Any thoughts? See, if you look at cost of sales, these are directly attributable to generating the revenue, right? Directly attributable. Raw materials, work in progress, finished goods, which were used in producing the revenue. But when we look at overheads, these are the indirect cost, as we mentioned. Research and development, do they have an implication to generating revenue? Yes, but is there a direct relationship to generating this revenue? Not necessarily. Depreciation and amortization. Is it related to generating revenue? Yes, but is there a direct relationship? No. Right? So you can see the direct cost structure crossover here, indirect overhead cost structure over here. Right? Then this information gives us the profitability level at the operating level. At the operating level. This is at the gross level. Why gross level? We are saying it is at the gross level, guys, because it still isn't considering the entire operations of the business. Because selling and distribution, administrative, research, depreciation, these are also part of my operation. Can I call this operating profit? No, I can't. Because these two relate to my operation. But can I call the profit at this level operating profit? Yes, I can. Because now I've captured depreciation. Now I've captured amortization. Now I'm capturing selling, general, administrative, and the whole gamut of it. So at this point of time, it is the profits which I have generated from operations. Understanding the income statement. Then comes the funding elements, right? Where does your funding element comes from? Interest income. Then you'll have your taxation. These are part of operations, but these are not part of the direct operations, right? These are information relating to your capital structure and tax efficiency. Look at the beauty of it, guys. If you break the components of it, therefore, impact of direct costs on my profitability, impact of indirect costs overheads on my profitability, impact of the capital structure, and impact of tax efficiency. These are the broader four components that are coming together, right? Which is brilliant. And now we've seen revenue recognition, we've seen expense recognition. This is how they all come together. I won't dive into the details of extraordinary items, etc. Since this was a real life example, it has additional information, but let's not confuse ourselves with more than what is necessary for us. Which brings us to that last line item, guys, net income. Right? What should your thinking be? I'm going to show you something which is very analytical, right? Net income. Now, this is essentially the amount of accounting profit a company has left over after paying all of its expenses, which makes sense, right? All the revenues that you have earned during the year, out of which you paid the direct costs, you paid the overheads, you paid your taxes, you paid your interest costs, what remains is your net income, right? In an analytical term, arriving at net income, how do we get there? All the components to arrive at our net income is what? Revenue generation, direct costs, overheads, financing, and taxes. All of these have an impact on us arriving at our net income. So if we were to simply calculate this, you can see across over here, we'll take our sales, we'll subtract our direct cost, we'll subtract our indirect costs, our financing cost, our taxes, and any other expenses like extraordinary items to arrive at our net income. No big deal. Revenue recognition, direct costs, indirect cost, financing, taxation, net income. And we know how to recognize revenue. We know how the expense recognition comes in. Interest cost is fairly easily calculatable. Taxation can be an entirely different subject. Usually you will use an easy assumption from an accounting perspective. Which begs the question, we are going back to double entry a bit. Now we start off with our revenue, all indirect cost, direct cost, financing, taxation, etc. we pass and we come into our net income. What do we do with this net income? How do we account for it? Right. That's the next question. What is the fundamental basis for our accounting? Double entry. Right. We saw the nitty-gritties in our last session. Very specifically, the accounting equation. What was our accounting equation? Assets equals liabilities plus capital. Correct? Now, how do we park this net income, right? We don't have assets, liabilities here. We had income and expenses here in the income statement in arriving at my net income. How does this net income flow to this accounting equation? Right? Let's assume this is an entirely cash basis, right? Let's leave the complications of accruals aside. We'll assume all of these revenues and all of these expenses are on the basis of cash, right? To make things easy for us. So I have now, after my operations, I have $100,000 of net income, hypothetically, which is in cash. Which is in cash. And cash is a what, guys? Cash is an asset. We will therefore flow it to cash at $100,000. And at the same time, this net income, who has a claim over this net income, guys? Who do you think has a claim over the net income? I have put money into a business. The business has generated $100,000. Who has the claim over this? Who has the ownership claim of the business? The shareholders. Therefore, the reciprocal is what? Under capital or under equity, we recognize another $100,000. Assets equal liabilities plus capital. So this is essentially how it is going to flow into the balance sheet thereafter. Has quite a few implications even from a analytical, financial modeling or other perspective as well. These were from our previous discussions, which brings us to the balance sheet. Right? So we looked at the income statement, we saw revenue recognition, we saw expense recognition, finance cost, taxation, and that bottom line of net income, how it flows across into the accounting equation and where we want it to go. Right? We can then come to the balance sheet. And if you remember in our previous discussion, when we were saying what is the balance sheet broad spectrum trying to tell us, it is telling us what? The position of the company. The position of the company. Remember, the balance sheet is prepared as at a particular point of time. As at 31st March 2023. As at 31st March 2024. So it will tell us what are our assets, liabilities, and capital as at that particular date. Whereas with the income statement, it was over a period of time. Right? There it was telling us performance. Here it is telling us position. So what? The balance sheet displays the company's total assets and how the assets are financed, either through debt or equity. Now, would you see that happening? Let's see if we can jump into this is an illustration of what the balance sheet would look like, right? What is this company? I can't remember, maybe Tesla or thing along those lines, I think. Right? So we have a balance sheet across over here. Now, we were told that the balance sheet is telling us how our assets were actually financed. Does that actually happen? Right. Let's again break down the components. Right. You have your current assets over here. You have your property, plant, and equipment over here. I'm looking at the biggest components, right? And then you have your goodwill, which is a relatively smaller component. Then you have your current liabilities, which is essentially working capital. Then you have long-term debt. And as you can see, this company has a lot of equity. And you have your total shareholders equity. Now, what did that statement say? Balance sheet displays the company's total assets and how they are financed. Look at the company's total assets, guys. Company's total assets are these numbers. Non-current assets, sorry, I beg your pardon, current assets and non-current assets. How do you think they are financed? This is one part of the financing which is coming through the shareholders' equity. And this is one part of the financing. Sorry, this is the other part of the financing which is coming through the long-term debt. So let's simplify that a bit. Let's say I have property, plant, and equipment of $100,000. As an analyst, where would I go next? I would like to see the liability and capital side of the balance sheet. On the liability side of the balance sheet, it is telling us I have borrowings of 25,000 and I have share capital or equity of another 75,000. I'm taking a perfect situation. Now you can see how have I financed this $100,000 of property, plant, and equipment, 25% via debt and 75% via equity. And that, guys, is that statement over there, which tells us the balance sheet displays the company's total assets and how the assets have been financed, either through debt or through equity. This is how, remember in our last session, we were talking about reading the financial statements. Financial statements are not about, okay, the property, plant, and equipment is 100,000, the current assets are 25,000, the borrowing is 15,000. That's not reading balance. In the balance sheet, that story has to come to light. And what is the story that in my illustration, the numbers saying the $100,000 of property, plant, and equipment was partly financed by borrowings, 25%, and a bulk of it was financed by shareholders' equity. That is the story coming together, guys. It can also be referred to as the member at the onset. The balance sheet is based on the fundamental equation of assets equals liabilities plus equity or capital, and the dividends, and it is divided into assets and liabilities. So you will know that, when you generally look at a balance sheet, you will see two sides of it, or it will be represented on a vertical basis. Classic current and current assets, color, non-current and current assets. What's the difference between one and the other? I mean, property, plant, and equipment, intangible assets, etc., in your non-current assets. Under current assets, for example, you will carry inventory, you will carry cash, you will carry debtors. What's the difference here, guys? What is a key element across over here, do you think? When we say current versus non-current. See, these captions, the non-current asset captions, are going to be in place over more than 1 year, right? Property, plant, and equipment is not here today and gone tomorrow. It's going to be there over a period of time. Intangibles, for example, more often than not, their useful economic lives will span more than one accounting cycle, more than one business cycle, more than 1 year. Current. Current assets, do you see inventory is being held for 2 to 3 years? Do you see receivable for late as well? Any obligation short term will be due across the longer term. They have a period of time. Where would that go into? It will go into the non-current portion. I have a bank overdraft. You're not going to get a bank overdraft for a year. You'll get it for weeks, for months, if at all, right? That is the short-term component, which will run into the current portion of the liabilities. And then, of course, you have the share capital. This is the amount of share capital that was input by the shareholders. Retained earnings is what we are, the portion of the net income that we do not distribute. Why do I say do not distribute? Let's talk about that as well. So initially, when we spoke about net income, actually we dive into this detail, we'll go in, let's move on. Now we see the detail for your total assets. These are the captions which come in. The non-current assets held by the firm, operations over a longer term period. How do we define the long term? More than 1 year, more than one operating cycle. Example, fixed assets, building machineries, etc. The current assets is a part cash and operate within that one operating cycle. Cash, debtors, receivables, etc. On the non-current basis, you can see intangibles, which may or may not be identifiable. When we say identifiable, tangible or intangible assets, shall we say? That is an entirely separate discussion, which we will see later on. Patents, licenses, goodwill, brand name. These also will generally be spanning over more than 1 year. Take, for example, the brand name of the brand name of McDonald's, Tesla, Apple. Are they only going to be in operation for 1 year, guys? No, they are going to be over a period of time, quite a period of time if you actually think about it, right? These will be recognized as non-current assets in the form of intangible assets. Which brings us to the total liabilities, which we broke down on the current and non-current context. The non-current liabilities, this is the sum of, more often than not, your non-current liabilities, the bigger portion, if not its entirety, is going to be borrowings. Right? Borrowings in the form of bonds payable or debentures payable, etc., all loans essentially, which are going to span over a 1 year, more than a 1 year period. Current liabilities, on the other hand, is the short-term component of the borrowings. It's the short-term creditors, for example. These all fall within one operating cycle, right? Now, for example, let's look at a practical situation. You might have, for example, borrowings to the value of $100,000. Let's say this $100,000 is relevant over a 5-year period, which means on average, not on average, which means we will be paying $20,000 per annum, correct? Now, there's an important distinction here. This is where the intellect needs to kick in, guys, right? See, so 20,000 into 5 years, I will pay off this loan. See, one of these $20,000 is relevant to the current year. One of these $20,000 is relevant to the current year, which means it is less than a 1 year period, right? This will be recognized where under current liabilities. The remaining $80,000 is what is going to be paid from years 2 to 5. That will be recognized under non-current liabilities. See how the definitions are falling into place nicely into how the entire statements, etc., have been constructed. Yes, this is a long-term loan, but there is one portion of this long-term loan which is going to fall due within a 1 year period. That is going to be a current liability. The remaining portion of it will go into the non-current liabilities. Right? Look for these information even in real life analysis that you may carry out. And then you had the shareholder, you had the total shareholders' equity. Share capital, the value of funds that the shareholders have invested in the company when the company was first formed. So let's say initially when the company was formed, we said that each share was $1,000 and there were 100 shares in play. Therefore, the share capital input by the owners is $100,000. Very simple. Retained earnings. So this is an interesting one. Right? Just as the name suggests, retained earnings, what we hold back. Right? So you will have, for example, net income. In year one, this is my first year of operations, right? This is my first year of operations. I had net income of $10,000, right? Out of this $10,000, $5,000 I'm going to declare as dividends. Means I'm giving you shareholders $5,000. Now this is out of the business. What is retained in the business, guys? What is retained in the business is $5,000. This is my retained earnings. Retained earnings, right? Let's carry this forward now. Now I'm carrying this $5,000 forward for future purposes. Right? Now it is year two. Now my business is doing really well. This year it earned $30,000. I declare $10,000 as dividends. What is retained in the business this year? $20,000. But don't forget, I bought $5,000 from the previous years, right? Which means my ending retained earnings balance is how much? $25,000. One more year. Year three, my company does even better. $50,000. I pay out 20,000 as dividends. What did I retain in the business this year? $30,000. I bought forward $25,000 of retained earnings with this year's $30,000. Therefore, I have $55,000 of retained earnings. See, what am I retaining in the business? Why would you want to do this, guys? Why would you want to do this? See, we want to grow. We want to fund operations. We want to finance our acquisitions. We want to move into new markets. We have new strategies. We want to develop new products. We want to invest in research and development. We can use our internally generated funds for this purpose. This retained earnings, therefore, is going to be that internally generated fund. So that is a bit of an analytical twist on it. So we saw how the income statement comes together, revenues, expenses, etc. How does the balance sheet come together? Right. Number one, you will list all the company's assets. Right. Remember our trial balance from our last discussion? All the accounts are there in the trial balance. From the trial balance, you will source all the company's assets. Then you will categorize all the assets. How will you categorize them? Once you've gotten all the assets together, then you start categorizing them. Current assets, non-current assets. Then you go to the liability side. You will select from the trial balance, you will select all the liability accounts and you will classify them. Current liabilities, non-current liabilities. Then you will go and from the trial balance, source all the equity or capital accounts. And you will identify the cumulative. Now you've got your total assets. Now you've got your total liabilities. And you got your equity. And technically, your total assets value should equal your total liabilities plus capital. Remember how in our last discussion last week, all the transactions recorded, journal, general ledger, individual accounts, trial balance. Today we are moving forward from the trial balance, we are moving forward across into the balance sheet. We saw how the income statement comes together, moving into the balance sheet. What if this doesn't balance, guys? Now you do all of this and it doesn't balance. So now we are sourcing all of this information from the trial balance. We will know at this point of time in the trial balance whether it is balancing or not. If the trial balance is balancing, but at this point of time it is not balancing, then there is an issue with how we have selected and classified the accounts. Then it is our problem because the trial balance is balancing. But there may be instances that the trial balance may not balance and you have suspense accounts, etc., which at this point of time is not part of our discussion, will be handled separately. Right? So we are seeing, guys, from transaction, a particular transaction has taken place. This was last week. How it gets journaled, how it goes into the general ledger and the individual accounts. From there, we bring all of that into the trial balance, and then we use the trial balance to prepare the income statement, balance sheet, and cash flow statement. You're seeing how all of it, how these financial statements, how they are coming to life, you are witnessing, right? So today we've seen the income statement. How do we recognize revenues? How do we recognize the costs? How does the financing? How does the taxation, net income, and how it flows into the balance sheet? We've seen how the balance sheet comes together from the trial balance, the different accounts, classified, and then we prepare the balance sheet, right? And then now we come into the cash flow statement. We know how the cash flow statement is different, or you should know by now. We have accruals for the income statement, but the cash flow statement is prepared on the basis of cash. This is not relevant. Is this cash applicable for the next year, or did we collect some receivables from the previous year? Not relevant. Did we receive the cash in this accounting period? Then it is relevant. That's it. Whether we received a receivable from the previous year, whether we have to make a payable in the last year and we made it this year, doesn't make a difference. Did the cash inflow or outflow happen in this accounting period? That is the number that they are looking at. Right. And very importantly, there is a major difference which we touch based on. Financial statements are prepared according to the accrual principles, therefore does not entirely reflect the cash position. This is the income statement. But the cash flow statement is prepared on the entire basis of what? Cash. Very, very crucial. Companies can choose to present. Now, there are two different presentation methods as it applies to the cash flow statement. Right? The direct method or the indirect method, right? Which we will talk about in a moment. What are the components of the cash flow statement? Right. This is a beautiful one, guys. One of my favorite areas to talk about. Right. So when you look at the cash flow statement, it will break the components down into the cash flows from operations, the cash flows from investing, and the cash flows from finance. Right. Cash flows from operations will show the revenue generated, will show the direct costs, will show the salaries, all relating to the operations of the business. As a result of the company being in operation for this period, what was the cash, not profits, what was the cash generated? Then you have the cash flows from investing. These relate to investing activities. Right? Purchases of property, plant, and equipment, sale of machinery, and then you have cash flows from finance. This relates to either equity or debt finance. I've given you the detail as well. Right? Let's look at it. Cash flows from operations typically include cash flows. Cash flows. We are constantly going to say cash flows here, no profits on the basis of cash. Typically includes the cash flows associated with sales, purchases, and other expenses, very importantly related to operations, guys. Cash flows from operations, relating to operations. Presentation methodologies include direct and indirect presentation, which we will talk about. Um, We'll look at that example in a second. Cash flows from investing include the acquisition and disposal of non-current assets, meaning buying and selling your property, plant, and equipment, machinery, etc. Investing cash flows typically include cash flows associated with buying and selling property, plant, and equipment, and other non-current assets and any other financial assets. And then you have the cash flows from finance. These are the results of the changes in the company's capital structure. Capital structure? Really? Why? Where is the broad spectrum capital structure coming from? Debt or equity? If I take on new debt, it will be reflected in the borrowings. It will be reflected in the cash flow under cash flows from finance. If I take on new equity, I issue new equity, I issue rights, I have a rights issue. New shares are coming into the company. More capital is coming in, share capital, equity is coming into the company. It will be reflected across in cash flows from financing. We need to be able to distinguish between these three. Cash flows related to operations, cash flows related to investing, and cash flows related to financing. Not difficult. Cash flows from operations, sales, cost of sales, salaries, etc. Cash flows from investing, purchasing or selling property, plant, and equipment, and cash flows from financing relating to issuing debt or issuing fresh shares, for example. This is already seen. Which brings us to this direct and indirect cash flow method. This is only applicable for cash flows from operations. Only applicable to which here for cash flows from operations. Other elements, meaning cash flows from investing and cash flows from financing, are unaffected by the direct versus indirect methodology. No problem there. The only element which will be affected by this direct versus indirect decision presentation methodology is the cash flows from operations. Right. I'll start with the indirect method. This is the one which is most commonly seen around, guys. How does the indirect method work? We start with net income. Now let me ask you a question. Is net income cash or profits, guys? Thoughts? Is net income cash or profits, guys? Now don't forget, income statement is prepared on the basis of accruals. And net income, net profit. Profit is not cash flow. We might have sold, but we haven't received the cash. We might have purchased, but we haven't paid the cash. So that is on the basis of profit, not on cash. This net income, we will make adjustments to convert to cash. And what are those adjustments? One is non-cash items. Non-cash items such as depreciation, amortization, impairment, etc. These are non-cash items. Why do we say depreciation is a non-cash item, guys? I have bought $100,000 worth of an asset and I'm parking it over 4 years as expense, right? Now, that depreciation, it's a provision. Is it actually going out of my business? It's not. It's only a provision of my profits. From my profits, I'm apportioning a portion of amortization, impairment, etc. It is not going out of the business. It is a non-cash item. Therefore, despite net income deducting these non-cash items, it is not a cash outflow. Therefore, we will reverse it back to identify the cash. So we are going to add back the non-cash items, which is what you can see over here. Depreciation, you can see is being added back. Then you make certain working capital adjustments. Then you make certain working capital adjustments. That is what is coming over here. Working capital adjustments. Take inventory, for example. Right? Very simple. You take 2 years inventory values. Right? You take the 2 years inventory values. In year one, the inventory value was 100. In year two, the inventory value was 150, guys. What is this telling you? Year on year, your inventory has increased or decreased? Your inventory has increased by $50. What is this equivalent to? This is equivalent to you having what? Purchased inventory. Purchasing inventory meaning it's an inflow or an outflow, guys? It is an outflow. It is an outflow, which is why you can see increases in inventory is recognized as a negative. Decreases in inventory is the vice versa. Let's look at the next working capital adjustment. Now we will look at, sorry, the next working capital adjustment. We look at accounts, let's say accounts receivables. Accounts receivable. Year one, I had accounts receivable of $150. Year two, I had accounts receivable of $100, right? Now look at it this way. At the beginning of the year, some guy had to pay me $150. At the end of the year, he only has to pay me $100. What is that indicative of? At the beginning of the year, you had to give me 150. But today, you only have to give me 100. That means you have paid me how much? $50, right? That's how it came down to $100, which is equivalent to me having received $50 in cash. Received $50 in cash, which is why decreases in accounts receivable is a positive number. Increases are a negative number. And our final working capital adjustment is accounts payable. Accounts payable. Same element. We look at it across 2 years. Year one and year two. Year one, the accounts payable was 150. Year two, the accounts payable was 100. What has essentially happened here, guys? Accounts payable has come down by $50. 150 I had to pay at the beginning of the year. I only have to pay $100 at the end of the year. What does that mean? $50 of accounts payable I have paid in cash during the year, which is why decreases in accounts payables, you are seeing as a negative value. As a negative value. These are the working capital adjustments. So what are the adjustments that are coming here? If you are considering the indirect method, to convert net profits, to convert the net profits to cash flows from operations, we will adjust for non-cash items such as depreciation. We will reverse them back because we have deducted them from the net income, which are not technically outflow. So we reverse them. And then we will adjust for working capital, inventory, accounts receivables, and accounts payable to arrive at our cash flows from operations. Only up to this point you will have the difference, and that is also, guys, only presentation wise, right? Only presentation wise. Because if you notice, see, investing cash flows, no changes, same caption, same number. Financing cash flows, where is financing cash flows? 500, 500, no change, no presentation, no issue. Cash flows from operations, also bottom line, no change, only presentation difference. Here we start from net income and come to cash flows from operation. Under the direct method, what do? We don't start with net income. Under the direct method, in layman's terms, how we like to say is, the direct method is the cash basis income statement. The direct method is the cash basis income statement. How? See, this is my revenue. This and this is my direct cost. This is my overheads. Paid in cash. Paid in cash. Right? And therefore, this is going to be my operating cash. The only difference. Preparing the cash flow on the basis of direct versus indirect method, only the operating cash flow presentation is different. Bottom line remains the same. Both are, if you notice, 300, 300. Direct method is like the cash basis income statement, revenues received in cash, expenses paid in cash, etc. Cash flow statement on the indirect basis. How does it work? You'll start with net income, make adjustments to non-cash items and working capital adjustments to arrive at your cash flows from operations. Bottom lines are the same. Presentation is the only difference. In fact, US GAAP and IFRS both prefer the use of the direct cash flow method. But most of the time, companies use, and you've probably seen the indirect method is what is being used. Right? Right, a bit of a technical heavy area, which you will do good to go back and kind of have a look as well to make sure that you are 100% on it, right? How do you prepare the cash flow statement therefore? Right now we know we saw how the income statement gets prepared. We saw how the balance sheet gets prepared. Now we are going to see how the cash flow statement gets prepared. We select our time period. We distinguish between the items, between the methods that we are using, whether it's the direct or the indirect method, right? And then we collect the documents or data, right? What is the information that we require? Income statement, balance sheet, non-cash transactions, material other transactions, previous cash flow statement figures for opening balances, all this source information we are going to want. Then we adjust for the non-cash items such as if you are talking about the indirect statement, depreciation, bad debt, amortization, etc. And then we complete the cash flows from operations. No biggie on the cash flows from investing and financing. Same for both the direct and the indirect method. No complications across. So we've seen the main financial statements, that is the income statement, balance sheet, and the cash flow, right? We also have a look at the statement of changes in equity. It's also another accompanying document statement, right? But still, It's an important one, not a the income statement, balance sheet, and the cash flow are the most focused ones, but this one is also important. What does it tell us? It tells us, let's take a step back. What is equity? Right? The money that the shareholders have invested in the firm, including what has been retained. Right? So it is not only the share capital, it is the share capital plus what has been retained. Guys, remember our shareholders' equity, right? Don't forget, if we say share capital, this is only the amount that has been put in at the inception or through a fresh share issue into the company. But when we say equity, it is going to be share capital plus the retained earnings, guys, right? Bear in mind, that is important, right? Which is what is being mentioned here. For equity, what are we talking about? Whatever the shareholders have invested in the firm, plus the accumulated earnings which have not been distributed. The statement of owner's equity reports the changes in the company's equity from one period to another. How has this equity value changed? Right? And if you know the components, just what we saw, you will easily be able to identify. One of two things mainly. Either there has been a fresh issue of shares or you have retained additional income. Very simple. The changes that are generally reflected in the equity include profits, dividends, inflow of equity, fresh shares, withdrawal of equity, losses, which are all applicable to shareholder transactions. Right? You can see it happening. You can see it happening. For example, you'll have the opening balance. Then, during the respective period of time, you will have additions and deductions. What are the reasons that you can see additions coming across? Net income, any other income, issue of new capital. Right? Other income, guys, these are investment in financial assets, not relevant for our discussion here. Net income, issue of new capital will increase the equity. Right? What are the reasons that your equity can reduce? We already saw one. We already saw one of these reasons, right? We already saw one of these reasons, dividends. And obviously, if you have losses, also similar to us recognizing a plus for net income, during the year, if we have a loss, obviously our equity is going to come down. Right? Very simple. It is for these reasons that our equity will change. Either you earn profits, which means your equity will go up, or you've had earned losses, therefore your equity will come down, or you have issued new shares, your equity will go up, or you have declared dividends, your equity will come. So how and why you would see the changes in equity taking place. Right. I actually think it's a good essentially you've seen as of today, guys, you see how the preparation, you're seeing how each individual financial statement is coming to life. Income statement, balance sheet, and cash flow. As of today, you have seen how it is coming together. Transaction to posting to journal to general ledger to individual accounts to trial balance to income statement, balance sheet, and cash flow, and statement of changes in equity. We've seen it all. Right? Today was a fairly technical session, but that's what final. Any questions, guys? I would highly recommend, having a go at the maybe a recorded sessions or etc. once again, just to make sure you're 100%. And if there are any questions, always feel free to reach out. Happy to put them into perspective, guys. Are we good? Do we have any questions, guys? Right. We'll dive into in our next sessions. We will dive into the merchandising more on the double entry side of things, accounting treatments, etc. And then we will dive into more along the specific lines of borrowings, long-term assets, and likewise. Right. All right. Since we are looks like we are okay on the questions, we will call it a day, guys. Hope you've had a good one. Have a great weekend, and we'll catch up soon for another session next time. Right.
Thank you very much. Thank you, Susa.
You're welcome, guys. Take care.
Thank you, Mr. Sana.
Bye bye.
Bye bye.